revalue gold to 142,000 an ounce, and the debt is offset immediately with your assets. Liabilities but that doesn't take into account the unfunded liabilities of Medicare,
Right.
Medicaid, Social Security. But the balance sheet, could it be done? Sure. The U.S. Treasury says we'll pay 142,000 for everyone that wants to sell their gold. Every country that would like to deliver it to the U.S. Treasury. Is it pie in the sky? Sure. Could it happen? Why not? With Bitcoin at 100,000, why couldn't gold? All the central banks have been accumulating it hand over fist. I'll say this. I don't know what they have in store for gold, but it seems very American-centric, and it's so far of an outlier, Paul, and anything I've ever seen, I can't even begin to explain.
The idea of revaluing gold to address U.S. debt has a historical precedent and continues to be a topic of speculation among financial analysts. Throughout history, gold has been used to stabilize economies, as seen when President Franklin D. Roosevelt devalued the dollar in 1933 by increasing the official price of gold, and later when President Richard Nixon ended the gold standard in 1971. Today, gold is valued significantly higher on the open market than its official U.S. Treasury valuation of $42.22 per ounce, sparking discussions on whether a modern revaluation could help offset liabilities and restore confidence in the financial system. Advocates of gold revaluation, such as Senator Cynthia Lummis, have suggested pegging gold at values as high as $142,000 per ounce, which could significantly impact the national debt. Central banks hold gold in a special category known as the gold revaluation account, which tracks its changing value. Some analysts argue that adjusting gold's valuation to reflect its market price could allow financial institutions to balance their liabilities and assets, potentially alleviating existing fiscal constraints. Recent developments in the gold market suggest a potential shift in its role within global financial systems, as central banks and major institutions continue acquiring gold at an unprecedented pace. The London Bullion Market Association, LBMA, reports substantial gold movements, with the United States becoming a net importer for the first time in years, while significant deliveries through COMEX, including billions of dollars worth from J.P. Morgan, indicate that major financial entities may be positioning for a revaluation. Andy Schectman highlights the scale of these acquisitions, questioning why central banks are purchasing gold at such extraordinary levels, and suggesting that this accumulation reflects an effort to rebalance global balance sheets burdened with liabilities. He notes that while a substantial revaluation of gold could theoretically eliminate large portions of sovereign debt and restructure financial obligations, such a move carries the risk of triggering hyperinflation and destabilizing existing monetary frameworks. We present the clips of Andy's latest video. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Every $4,000 increase in the price of gold would give the Treasury general account $1 trillion free and clear. And it's not so far outlandish to think that it could happen. Over my shoulder, you have Roosevelt there. His first act in office in April of 33 was to confiscate gold. Gold was $20 an ounce. That coin right there is a $20 gold coin, which was interchangeable with the $20 gold certificate back then. A dozen eggs were a nickel. He paid everyone $20.67. So they thought, geez, that's 11 dozen eggs. That's pretty good. Or 12 dozen eggs. That's pretty good. We're making a lot of money on this deal. But then he devalued the dollar immediately by 40%, revaluing gold by 40%. When Nixon closed the gold window in 1971, he then revalued at $35 an ounce, which is, by the way, what it is on every Western central bank balance sheet to this day, except in the United States, it's 42.22, because in 72, he revalued gold from 35 to 38. And then in 73 from 38 to 42.22. And the market has done the rest to revalue it to where it is now. It's held in the gold revaluation account. That's the name of it. You can't make it up on every central bank balance sheet. And as I was saying, the head of the Dutch National Bank for 2 years has been saying we need to revalue gold, at least market to market. Cynthia Lummis in a effort to fund the strategic Bitcoin account. And then you got guys like James Rickards, who says, look, $24,000 an ounce gold. And he comes to that by using a 40% gold backing and M1 numbers, dividing it into the number of ounces of gold that we supposedly hold. at Fort Knox and the Fed and the Denver and New York Mint. And he comes up with $24,000 an ounce, which would add $6 trillion free and clear to the Treasury general account, which would be able to start to work down our debt and inspire confidence. And to Judy's point, start backing treasuries redeemable in gold in 50-year treasuries with a very, very low, if not a zero coupon. These are the kind of moves that you would have to make in an effort to do this. Now, I'm just going to go out on a limb, and I'm not saying that this will happen at all, but you want to talk craziness. Revalue gold to 142,000 an ounce, and the debt is offset immediately with your assets. Liabilities but that doesn't take into account the unfunded liabilities of Medicare,
right,
Medicaid, Social Security. But the balance sheet, could it be done? Sure. The U.S. Treasury says we'll pay 142,000 for everyone that wants to sell their gold. Every country that would like to deliver it to the U.S. Treasury. Is it pie in the sky? Sure. Could it happen? Why not? With Bitcoin at 100,000, why couldn't gold? All the central banks have been accumulating it hand over fist. And when you see what is happening right now on the LBMA, which is in essence in default, in my opinion, and the amount of gold that has been shifted, over 20 million ounces since November of last year, have come into the United States. We've become a net importer of gold. Largest deliveries we've ever seen in the history of the COMEX coming to the gold ever in the February contract, almost 6 million ounces. JP Morgan delivering 4 billion of gold into COMEX for a customer. Who's got 4 billion? Who is that customer?
Right.
Is it the Fed? Is it the Treasury? Is it Warren Buffett? Who knows? Point is that crazy things are happening that no one's ever seen in my 35-year career as it pertains to gold, the importation of it, the reshoring of it. I'll say this, I don't know what they have in store for gold, but it seems very American-centric. And it's so far of an outlier, Paul, and anything I've ever seen, I can't even begin to explain.
Andy believes a large-scale gold revaluation could dramatically reshape global finance, potentially weakening the dominance of the U.S. dollar. Since the dollar's stability relies heavily on U.S. Treasury securities, shifting toward gold as the preferred store of value could disrupt international trade and monetary systems. If central banks continue accumulating gold and repatriating reserves, the global economy may experience a paradigm shift where gold-backed assets gain prominence over fiat currencies. Andy sees this as a direct challenge to the existing financial order, especially with institutions like the Bank of England struggling to meet physical gold deliveries amid rising demand. The implications of a significant gold revaluation extend beyond trade, raising concerns about hyperinflation and debt restructuring. If gold prices surge to unprecedented levels, Andy notes that it could create chaos and opportunity, potentially triggering runaway inflation while simultaneously offering a means to eliminate massive national debts. This prospect fuels intense debate among economists and policymakers, as some see it as a necessary step toward a more transparent, commodity-backed system. With central banks stockpiling gold and financial leaders discussing gold-backed instruments, Andy believes the possibility of a major financial reset is no longer just speculation, but a scenario worth watching closely.
Those inflation numbers are flat out lie. They are not 1.3. That's what they tell us. That's what they want us to believe. I wish it were only that way. Go to shadowstats.com. He'll say add an 8 to that, and you're closer to 9 or 10% than you are 2. But in order to accomplish the agenda, if this is the agenda, you have to incentivize the lowering of rates. Well, you bring down inflation and slow down the economy. And in my mind, we're heading to stagflation, which would be, higher inflation coupled with little or no economic growth and a slowing economy and higher unemployment. And that to me is more reality. But I think indeed, if this is what they are trying to do, yes, you will see them pivot and you will see things like gold do very well. And maybe that's why we've seen a mad dash, a scramble, if you will, by not only the most well-funded traders on the planet, Paul, but the most well-informed. And we can say what we want about the vials of the central banks. They know the playbook, period. And they have been buying gold across the globe for years now and repatriating it. We've seen over 40 banks. I'll just mention, see if I can pull it up here in a second, just in a simple Google search. These are the banks that have brought their gold home over the last few years, from the New York Fed and the Bank of England, Germany, Austria, Slovakia, Argentina, the Netherlands, Saudi Arabia, Hungary, Belgium, Egypt, Senegal, Romania, Nigeria, Poland, Ghana, India, Turkey, France, Serbia, Venezuela, Algeria, Cameroon, South Africa, Czechoslovakia, just to name a few. We saw the Bank of England buy massive amounts of gold over the last couple of years, bring it all home to India, including 100 metric tons they've held at the Bank of England since 1991. And we're seeing this as a continual trend. Now, the Bank of England is more or less the backbone of the LBMA. The LBMA is a T+1 settlement where you do your trade on Monday. You had T1 is the settlement day. Tuesday, you're supposed to have access to your delivery on Wednesday. They're now T+8 to 9 weeks. And that's a default, in my opinion. They say that it is a lack of manpower and trucks. No, it's not. It's much more than that. The LBMA has 36 million ounces available. Of the 279 million ounces stored on paper, only 36 million is unencumbered. This is standing against 380 million ounces in outstanding spot contracts. That's almost 11 times as much paper as there are bars. That's a big problem. And we've seen the largest monthly outflow of silver ever out of the LBMA this last month. Their float is only about 270 million ounces. They're trading 2.9 billion with the B ounces per day, non-backed. That's 3.5 times annual global mine supply. There's a rumor out there, and I can't substantiate it, that he's pissed off at the aristocrats of Europe, and he's getting back at them. It started with moving LIBOR to SOFR, and that Powell's in cahoots with Trump on this, and that he's trying to blow up the Bank of England and the banks surrounding it. The rumor is that the U.S. banks have gone long. The European banks are wickedly short, to this degree, 90% short, and there will be a failure of delivery. And so what did the Bank of England do? Yeah, we're short on manpower and trucks. I know we've delivered, a gazillion ounces to you already, but now we're short on manpower and trucks, so we're going to have to make it an 8 to 10 week delivery instead of T+1. That's a default. Battle lines are being drawn, and whatever is happening with gold is way an outlier, way off the charts, where these contracts they've been able to do for years and years and years and years in cahoots with the COMEX, where the COMEX would set the price, the LBMA would be the delivery mechanism, but really very few people stood for delivery. It was a
Right.
speculative endeavor or a hedging endeavor. And now all of a sudden you see the West, who has always been a net exporter since November, we're a net importer. And started with the Trump tariffs. That was the ruse, if you will, I think, to incentivize or to make the banks in England think no big deal that there's a whole bunch of naked contracts on COMEX. These banks need to do what's called exchange for physical, where you take a COMEX contract, which is highly fungible, you send it to London, they get the cash, London sends the metal back, and it's been going back and forth like that forever. Well, now it seems to be a one-way reshoring, onshoring trend, and I think the Bank of England's like, aha, this is deeper than we think, and has put on the brakes. So yes, I think there are a lot of things happening that could very quickly not only change the landscape economically, but for very much so for the price of gold. And I do think that it will be pegged to a system, to a new system, and it will be revalued. And it would benefit all the central banks. They're the ones who've been buying it and reshoring it themselves, really going back to 2017. So I wouldn't put that by Trump at all. I think he understands this. And then having Scott Bessent as your Treasury Secretary, who when he was running a hedge fund, gold was his largest holding, and having an advisor like Judy Shelton, who advocates for issuing treasuries collared by and redeemable in gold in 50 years. The first step would be to reshore. The second step would be to revalue, which would then reliquify the treasury, mitigate the debt, and then install confidence through stable coins, is what Judy said. Issue stable coins off of it, she says, and create a system where we now have confidence, all of it pegged to blockchain, so everyone can see not only the amount of gold, the amount of spending, the amount of stable coins, everything. Transparency in commodities, as Zoltan Pozsar says, Bretton Woods 3, the system we're in now, where Bretton Woods 1 was after World War II, Bretton Woods 2 loosely when we signed the deal with the Saudis, who they did not sign the exclusivity deal last year to re-up that 50-year deal. They said, we'll still take dollars, but not exclusively. Bretton Woods 3, a system, as Zoltan says, and one of the smartest people on the planet, which will be identified by commodities and transparency. So Could this be happening? Absolutely. Do I know it to be? No, I have no idea. It could be Trump tariffs. It could be Basel III. The Basel III regulations go into effect July 1st in the United States, and that is the gold that is held in physical possession, unencumbered on the balance sheet is tier one. And they have massive amounts of rehypothecated, unallocated, naked positions that, okay, they're reshoring. Could it be that? Sure. Could it be the tariffs? Sure. Is it? I don't think so. I think it's much deeper than that. There is no reason that the most powerful bank in the world would have reclassified gold tier one. And to see the moves that we are making so drastically, just tell me there's something deeper in store for the price of gold.
The era of gold standards may seem like a relic of the past, but current global dynamics hint at a potential resurgence. The push to repatriate and revalue gold signals a broader reconsideration of financial resilience and stability. As nations accumulate gold and explore its revaluation, they effectively hedge against systemic risks. Whether this transition leads to hyperinflation or a new stability phase remains uncertain. What is undeniable is that the world is at a crossroads, and gold, with its deep-rooted significance and intrinsic value, is set to play a crucial role in shaping financial narratives for generations to come. If this trend accelerates, it could redefine monetary policies, shift global power balances, and challenge the traditional role of fiat currencies. That's it for today. Share your thoughts on Andy's analysis of gold revaluation in the comment section below. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. See you in the next video.